So, similar to yesterday, this 15 tick trail, a trail far tighter than I've ever used in the past, looks like getting stopped out to the tick on the pullback. I'm going to get really angry here, and yet it turns out to be a pretty good exit. All right, so the data is validating. Rather, reality here is validating what the data analysis shows. The other question was, I made the statement, I have this love-hate relationship with the indexes, and what did that mean? The indexes are too volatile to trade. And if you try to trade them, it's just an experience and frustration, similar to banging your head against a wall or sticking a screwdriver in your ear. But all of that volatility that we experienced here led to improvements and enhancements and changes to this system, to my machine learning system, that ultimately have made it much, much better. And we're seeing, we're seeing that now, or at least in the last, we're 3.5 weeks in. We're seeing the fruits of that, though it is a small sample size yet, so we can't draw conclusions. So that's the love part. The love part is that all that work is, I'm seeing that bear fruit. The hate part is that it was such a frustrating experience trying to deal with all this. I went live March, right in here somewhere, right in the middle of this craziness, and then spent a lot of time dealing with, really we were first answering the question, can the machine handle this, yes or no? And then the answer was, well, yeah, it can. It can make decisions quick enough. And then it was, we spent a lot of time questioning whether or not the quality of that decision was high enough to be useful. And ultimately, it led to my much deeper understanding that I have about what volatility actually means and how it's represented in the data. Okay, and that in turn led to sort of abandoning the indexes in favor of markets that are not crazy, and the results have been, at least thus far, pretty encouraging. So I am a little worried that the indexes are a distraction, and I'm thinking about taking them off. I want to keep them current because they will settle back down, and when they do, I want to be ready. But here's the problem. All right, I had a conversation with a member the other day, and he was going, well, I was looking at it last week, and I saw a couple of days where it would, it worked really well, it was really profitable. And so he was all excited about trading it, and I'm trying to get the message across that we can find patterns in random data because we're human, and that's what our brains do. And you can roll the dice repeatedly, and there'll be times when it's favorable for you. All right, but that doesn't change the random nature of what you're doing. And you're better off staying away from the volatile market. You need to set aside this desire to catch these big moves you see the index is making, because catching them is really, really hard to do on any kind of consistent basis. So that's where that statement's coming from, and I'm concerned that having these down here act as a distraction and focus attention on them, when really that's at this point that I don't think they're tradable, and I'm not trading them live. So I'll give that some thought here over the holidays, and then come back next year with a decision. And here we are at the end of the day, and the one trade that we just saw in oil was the only one I ended up taking. So 35 ticks there. Gold, no trades. Yeah, very quiet day here. So again, it's kind of one of the things I like about what we're doing here is that when it's quiet and choppy and ugly, we end up just not doing anything, and that's exactly the right thing to do. And then in the euro first live trades in the euro here, and let's see, a short there that scratches, so we're trying my 20 there, and then a long there that takes a 7-tick loss, so minus 6 ticks on the day in the euro, which works out to $36 and something, $37, something like that, 6 1/4 per tick. So the result for the day is 350 minus that. Let's see here. Trade activity log. Yeah, so 312.50 today. And then for the, since we started here at 1622, so doing pretty well. And I think the earlier discussion in this video was, during the live trading, about the, just getting away from the indexes that are essentially random and applying what we've learned to markets that are not so random. And you might pair today's video with yesterday's. If you didn't see yesterday's, there was a discussion there about randomness and the nature of volatility and randomness. All right, so we will see what tomorrow brings. Tomorrow is Wednesday, which means it's oil news day. So we need to change the oil chart to trade, to black out the 10 minutes around that news release. So that means we go until 7:25. Okay. Unfortunately, this is not set up to define time ranges per day. That would be useful here for oil. This is the only one that has this issue, but it's a little bit of a pain. If you forget to do it, you may end up taking a trade during a time when you don't want to. And if you just leave it there all the time, you may end up missing a trade you want to take. So you're gonna have to just have to do it manually at this point. Okay, so that's ready for tomorrow. And after giving it some thought, I think I'm going to just take the indexes off the live trading here because of their potential distraction. Move gold back down or something. And that's it. We will see you tomorrow. Take care.